When we are talking about long-term liabilities or debt, we're really talking about the financing of a business. Obtaining resources is necessary to operate successfully a business. Businesses need capital. They need resources. One of the ways to get that capital or resources is to borrow it. We refer to this as debt financing. For example, accounts payable. What's really happening when we incur accounts payable? We're buying inventory on account. We're obtaining an asset or a resource to better operate our business and incurring an obligation. In notes payable, we're borrowing cash. Bonds payable, we're borrowing cash. And other payables, again, we're borrowing something in order to operate our business, to obtain some resources or services so that we can operate the business and hopefully generate a profit. One of the two basic ways to finance a business is to borrow resources or capital. The second way is through what we refer to as equity financing. That means we get resources not by borrowing them, but we get resources from investors or owners. And investors or owners provide resources to a business one of two ways. They either make contributions of resources, we'll call those capital contributions, and when they make those resource contributions, they typically receive in exchange an ownership interest in the business, evidenced through some stock certificate. So owners or investors provide resources to a business in exchange for ownership rights reflected in stock. The other way that owners can provide resources or financing to a business is by allowing the earnings of the business to be retained in the business rather than taking those earnings out for their own personal use. Again, the profits of a business accrue to the benefit of the owners. The owners, through dividends, can take those resources out of the business. But many times, owners are more interested in seeing that business grow and generate even more profitability in the future. And so a lot of times they will decide to allow resources created through profitable operations to be retained in the business rather than taking those resources out for personal enjoyment. This amount of profit-oriented increases in resources allowed to be retained in the business is referred to in retained earnings. We've just discussed some of the most common forms of debt financing in the first part of this lesson. Now we're going to focus on how owners provide financing or resources for a business in exchange for stock. There are two basic forms of corporate ownership or capital stock. The first is called common stock. Common stock is the most basic form of ownership issued by all corporations. Common stockholders have the right to vote in corporate matters, such as the election of a board of directors. They also have the right to share equally per share in any corporate profits. They're the owners. They're the ones that benefit from corporate profits, and they have the right to share equally per share. They have the right to share in those profits through the dividends. And in addition, any distributions to the owners in the event of a business termination would be distributed equally to the shareholders. All companies issue common stock and are controlled or owned by the common stockholders or owners. Who owns Coca-Cola? Who owns, IBM or some of these, large companies here in the United States? Well, the owners are the stockholders, the common stockholders. They're the ones that are voting on the affairs of the business. They're the ones that have the right to share in the corporate profits through dividends. In the event the business terminates, they're the ones that have the right to any of those resources that are left over after having paid, any liabilities. These are the people who are really the beneficiaries of what's going on in the business. But who are the stockholders? The stockholders are ultimately people. It's your grandparents or maybe even yourself, theoretically. I mean, let's assume that you're teaching at a local elementary school and part of your pay is, you participate in some kind of a retirement or a pension plan, and the funds of that pension plan are invested in stocks of companies in the United States. You might be an owner of IBM. We shouldn't look upon these companies so much as like the evil empire, because the owners of these businesses are Americans. They're you and me and people. They're the ones who realize the benefits or any problems that may arise as a result of the operations of a business. There is a second form of corporate ownership that comes through what we call preferred stock. Preferred stock is really a supplemental form of ownership, in addition to common stock, which provides certain preferential but limited rights to those of common shareholders. Preferred shareholders typically have no voting rights, but they do have a limited priority right over common shareholders to dividends and to distributions in the event of termination. Many companies do not issue preferred stock, but it is an option available in seeking financing for a business. Now, let's look a little bit more closely at common stock and the accounting for capital contributions made by owners in exchange for common stock. Here's an example. Let's take a look at this. Let's assume a company issues 10,000 shares of 1 penny par value common stock for $50 per share in cash. In this particular case, the business is receiving from investors cash of $500,000, and there will be a debit to cash for $500,000. There should also be a credit to contributed capital, owner's equity, because it reflects how much has been contributed to the business by the owners of $500,000, but we need to address this term par value before we make this entry. This term par value is really an insignificant and antiquated business term. I wish, in fact, it would kind of just disappear. The fact of the matter is this term par value has been around for years and years and frankly is obsolete. But because it exists in many states, and it is the states individually that has the right to authorize and allow for the incorporation of businesses. So if in fact you wanted to start a corporation and you're operating in the state of Utah, it is the state of Utah that has the right to establish your business as a separate corporate entity. And therefore you must follow the laws relative to incorporation of the state of Utah if in fact that's what your game plan is. By the way, even though you may be operating in Utah, you can almost choose to incorporate almost anywhere if you want. Many companies incorporate, for example, in the state of Delaware, have for years because of what may be considered maybe more favorable laws relative to incorporation. However, anciently, in these corporate laws established by states, many states established a requirement that if a company was incorporated and was going to issue stock, they must establish some par value. And the purpose of the par value would be that the stock must be issued at a price or in exchange for a contribution in excess of the par value, and that any future distributions to the owners returning their capital contribution to them cannot be more than the par value. And so what basically happened here is because when companies incorporated, and in fact they were required under state law to establish a par value and issue their stock for capital contributions in excess of the par value, what happened here was that businesses said, okay, I've got to establish a par value and it's going to have to be issued at a price contribution in excess of the par value. Fine. Par value is a penny per share if I have to pick a price. Now, I want you to notice something here. The par value for this company in this example is a penny per share, but that's not the stock price. That's not how much we are issuing the stock to investors for in exchange for a contribution. The stock's actually worth $50 and we're receiving $50 as we issue the share of stock. Why do we even have this par value on here? Because some state has on their books a law that says you must establish a par value. Traditionally, because of this requirement, when we've actually recorded these transactions, and frankly I don't really agree with this, but the way we have as accountants traditionally done it, is we will credit capital contributions, or let's call it common stock, because that's what's being issued here, common stock, let's be specific. We're giving up ownership. This is ownership interest. We'll call it not capital stock, we'll be more specific. We'll call it common stock, and we'll say common stock at a par value of a penny per share. Well, at a penny per share and issuing 10,000 shares, then the total capital contribution that is reflective of the total par value is $100 of that $500,000 contribution. Not too significant. Most of the contribution represents amounts contributed in excess of the par value. That's because they set the par value so doggone low. So really, this stock is selling, and most of the contribution comes in excess of par value. We will call that paid in capital in excess of par value for the common stock. And that paid in capital in excess of par value, because the par value is a penny a share, was $499,900. Both of these accounts, the common stock account and the paid in capital in excess of par account, are accounts reflected in the balance sheet under contributed capital. If we look on this particular balance sheet here, we see contributed capital, common stock, $1 par. We have $100 of par value that has been contributed. But the contributions, or paid in capital in excess of par, are the $499,900. The total contributed capital was $500,000. Now we're just setting up retained earnings here to show you that in the stockholders' equity section of the balance sheet, you will always have two categories, because there's two ways that owners provide capital or resources to a business. And again, stockholders' equity is not the resource. It is simply a description of how much of the resources or assets have been provided by the owners and how they've been provided. And there's only two ways owners provide capital, resources, or assets to a business. They contribute in exchange for stock, or they do it by allowing resources created through earnings to be retained in the business. And so these are the two categories. Contributed capital, in this case, that's $500,000, and retained earnings, we'll say, is $250,000, such that the total stockholders' equity is $750,000. Now, frankly, from my standpoint, as a person reading this balance sheet, an investor or creditor, I'm going to look at this and I'm going to say, what the heck is this par value thing? Well, hopefully I'm a sophisticated, intelligent investor, and I know that it is, number one, not very much in terms of its amount, and in fact is meaningless, because what I'm really interested in is the total amount that was contributed by the owners in exchange for stock. And I know that $500,000 was contributed, and there were 10,000 shares contributed, so there must have been contributed for $50 a share, which is apparently what the value of the stock is, at least at the time of contribution, or at least you'd make that assumption. The only reason why we're segregating out this par value is because of a stupid tradition, which in my mind we ought to stop doing. Just say common stock, $500,000. But this is what you'll see in a balance sheet today, so at least recognize it and note the insignificance, because see, one of the problems you'll have is that you might have some unsophisticated investor look at this balance sheet and say, wait a second, this stock's only worth a penny a share. That's not true. That's not what par value means. Par value means it is a value assigned by management because it's required by the state under some archaic law, and that's it. But the stock must be issued at a price above the par value, and in this particular case, it was $50, $49.99 above the par value. And so it is not necessarily a reflection of what the stock is worth. It's really very meaningless. There have been some states that basically recognize that par value doesn't have any meaning, but then they basically duplicated the same stupid concept by establishing what they said was a requirement to state some value. So let's change the example. Let's say a company issues 10,000 shares of 1 penny stated value common stock for $50 each in cash. Well, this is the same thing, but instead of a par value, they got some archaic stated value here. And you'd account for it the same doggone way, although I think it's kind of stupid. Debit cash for $500,000, that makes sense. And credit contributed capital common stock, I'd do it for the full $500,000, but traditionally we'll just break out the stated value at $100 and show the paid in capital in excess of that should be stated value of the common stock at $499,900. Again, on the balance sheet, given this common stock with a stated value, will reflect it exactly the same way under contributed capital, the common stock of $100 stated value and the $499,900 of paid in capital in excess of par. What's important is the total contributed capital. You know, the other day I have to tell you, a friend of mine showed me, he was issuing some stock for a business, and I was actually looking at the stock certificate and stuff. And again, this was a business that was incorporated in Delaware. You know what the par value was on that stock? I mean, this is how ridiculous par value is. The stated par value, the par value for the stock was 1/4 of 1/10 of a penny. I mean, what's this? See, they figure, hey, if we've got to issue stock above a par value, we'll just establish a par value as low as possible, and it's a non-issue. Again, originally, these states, I'll make this last statement, then we'll move on. Originally, these states set this up thinking that when the shareholder would contribute the cash of $50,000 and that there was a par value, that the business would be disallowed from basically giving them back all of the $50. They'd have to retain in the business at least the par value. And that maybe this would protect creditors who are making loans to the business, relying on the investment of owners to kind of protect their creditor status. Well, the fact, since you can establish a par value at any amount that you wish, then really it becomes very meaningless and really has no protection for creditors or other investors. In most states now, or many states now, they basically have eliminated this language of par, stated values, recognizing reality, and they basically just say you can issue the stock at whatever value you want to, and you don't have to establish any par value. And in fact, companies will issue the value at stock at any value they want to anyways. It's just whether they establish a par value or not, as required by state law. Most states basically now say, hey, we're not going to get involved. You don't have to have a par value. In this particular case, if that were true, we'd simply debit cash for $500,000 and credit common stock. We may note that there is no par value, although somebody may misinterpret that. Say, there's no value in that stock? It has no par value? An unsophisticated investor's response. But in this case, the common stock is simply credited for $500,000. And on the balance sheet, we'll show under contributed capital common stock at $500,000 and the retained earnings of $250,000. And in my mind, that's the best way to go, and certainly is clear in my mind. Now, I want to talk a little bit more about some of the advantages, not advantages. What I really want to do is talk about some of the disadvantages in raising capital through the issuance of common stock. You know, if I'm starting a business and I need some capital, I'd like to borrow from a bank or something, but maybe I can't. If in fact I'm going to try and get investors to invest capital or resources in the business and give them some ownership rights, I'll do it through the issuance of common stock. But there are some disadvantages. Probably the most significant is that I've now given somebody else rights, and specifically a vote and a say in our business operations. Somebody else owns this business and has a right to the financial statements. They have a right to know what's going on. And the other thing is that they also are given the rights to participate in any of the monetary benefits of the ownership, meaning dividends. Or if I own some stock and the stock price increases, then somebody else is gaining from the value of increases in stock because of the operations of the business. And if in fact we terminate the business, somebody else gets to participate in any of the proceeds in the event of liquidation. And so, one of the disadvantages, or the disadvantage of common stock is that you're giving somebody else a piece of your action, a right to knowledge, information, and a vote on what's going on. It's like getting married. Somebody else is now sharing in your business life. Not that marriage is a bad thing, it's a good thing, but in business, when you bring in other owners, it's like being married to somebody that you're not really physically attracted to. And, sometimes marriage is hard enough. You throw out the physical attraction, and sometimes it can be kind of tough. So again, bringing in other owners means other people have a voice and say in something that may be very precious to you, your business. Plus, it could be very expensive because if your business makes huge profits, we're making millions, somebody else is sharing in these huge profits. But there are also some disadvantages associated with getting capital through debt. And remember, the two ways that really you raise capital is by giving up ownership or through investors, or by trying to borrow funds. The disadvantages of borrowing is that it's got to be paid back. When you borrow something from the bank, $100,000, it'll establish a maturity date, and so it's not yours forever. You're going to have to pay that money back. So really, the capitalization through borrowing is temporary. Plus, there are scheduled interest payments due, regardless of whether your business is performing well. And if things aren't going well, and an interest payment is due, and you don't have the money, then you could, face some serious consequences, and may even face potential forced liquidation of the assets in the event that you're not able to meet those timely payments under the debt. Preferred stock is really a form of equity ownership that is designed to avoid the disadvantages of common stock, meaning the sharing of a say in the business and the sharing of what you hope will be big profits, So preferred stock is designed to try and avoid giving somebody a say and sharing your huge profits without actually becoming debt that has to be repaid in the future. As a result, preferred stock is typically designed to be non-voting. Most preferred stock has no voting rights in what goes on in the business. Preferred stock is also typically limited in the sharing of dividend distributions. They will not share equally in the profits with common shareholders. They typically will share in profits, but on a limited basis. In addition, the contributions of the preferred stockholders will be reflected as owner's equity on the balance sheet because the company is not required to repay the amount of capital contributed to the business by the preferred shareholders, except in the event of business termination. You see, under preferred stock, because there is no obligation to repay the contributions received in exchange for it, it really is not debt and doesn't suffer the disadvantages of debt. But it doesn't suffer the disadvantages also of common stock because preferred shareholders are typically not allowed to vote and they can't share in the huge profits of the business. They have limited rights to dividends. Well, you must be asking the same question I'd ask. Why the heck would anyone ever make capital contributions to a company in exchange for preferred stock? I mean, they don't have any say in the business. We're limited in terms of how much we can participate in profits. And basically, we don't have the right to get repaid at some future date. I mean, why would you ever make that kind of an investment or make a contribution to a business in exchange for this kind of ownership, which is pretty measly? Well, preferred shareholders have dividend limitations, but they also have certain dividend rights or preferences. The preference is that even though we may be limited in terms of the amount of the dividends that we have a right to as a preferred shareholder, we get our dividends first. We have a preferential right to our dividends before our share, even though limited, of dividends before common shareholders get anything. So that's good. We get our dividends, even though limited, before the common shareholders. In addition, preferred shareholders also have preferences in the distribution of assets in the event of termination of a business. If the business terminates and basically takes their resources, pays off all the debts, then the preferred shareholders stand in line next and get their capital contributions back first before the common shareholders get a penny. So they do have a preferential priority right to limited amounts of dividends and to their contributed capital in the event of liquidation. In addition, there are some tax benefits to holders of preferred stock if they are corporate investors. And so most of the preferred shareholders in the United States are actually corporate entities that are taking excess cash and making investments and buying preferred stock.